Okay, before we jump into the nuts and bolts of the valuation models, let's back up and take a look at this reading on industry and company analysis. Now this is again mostly soft material, meaning there's not a lot of number crunching here. But in order to understand valuation, the notion that you have to understand the broader world is certainly going to be true. So thinking about, what's going on with the macroeconomy, then the industry, and then the firm is a great mindset to bring to the valuation process, especially as it relates to the CFA exams. So understanding where all this is sort of going, I think, is a good exercise in exam prep. So uses of industry analysis. Well, we want to understand the firm's business environment. So what's the growth prospects? Who is the major competition? What are the threats to our growth and profitability? We also think we may also need to use industry analysis in terms of being active managers, meaning that not that we're active managers of a firm, but active portfolio management. So we are going to think about industry or sector rotation strategies and how we're going to weight different industries or firms in our portfolio. Well, in order to do that, we're certainly going to have to understand and use industry analysis. And then finally down here, performance attribution. So it's great that your benchmark portfolio had a return of 9% and you earned 11.5%. Well, I'm going to want to know how you generated that positive alpha. Well, part of that is going to be from how you chose to invest in industries and weight the different industries. So we can also use this industry analysis stuff in terms of understanding how managers either create or destroy value with their portfolios. So approaches to industry grouping, well, a couple of ways to do this. So one would be by product and service. So you can group by sector or primary business activity. We're going to see some more on this later. The other approach would be to base it in sort of the economics of business or industry returns, and that would be to look at business cycle sensitivity. So you can think of is this a cyclical industry or a non-cyclical industry? So cyclical or high sensitivity to changes in the macroeconomic cycle, that's going to be consumer discretionary. So luxury goods and things that we buy that are expensive that we don't have to buy. Energy, technology, those types of things are going to have high sensitivity. On the other hand, we also have low sensitivity industries and companies. Those are consumer staples and healthcare, things that we're not able to do without. So if the economy is really poor, well, we still got to buy, cereal or whatever it happens to be, or wheat or something along those lines. So you can think of this as we have a business cycle. Is this a firm that's going to follow the business cycle? Is it going to follow the business cycle but in an exaggerated fashion? Or is it going to be something where the sensitivity to the macroeconomy is less than what would be the average in the economy? So what about industry groupings here? A way to think about industry groupings would be to use statistical grouping. We can use the statistical grouping algorithms in a number of places in the curriculum, and they always bring them up and they always point out their limitations, so you ought to know what they are, but this isn't something I think you need to pursue more than understanding what it is. What we're essentially doing here is we're allowing the computer to build groups, right? And the computer is going to build groups where the correlation and returns or whatever it is we're looking at, revenues, growth, return on equity, is going to be highly correlated within the groups, and they're going to create groups, and the correlation between the groups is going to be low. So you want high correlation within group and low correlation across groups. The problem with this is that, the historical correlations may not persist, but that's always going to be a problem. And the groups can change over time. That's always going to be a problem too. But the big problem that you always run into when you let the computer do the thinking, right? Let the computer take and apply this algorithm to sort of divide and segment. Well, the segments are going to be non-intuitive. So it might have, during the historical period that you were looking at, certainly this was true. The computer didn't make any mistakes. But if it's non-intuitive, it doesn't give you a very good basis for which to plot portfolio strategy going forward. Okay, common classification systems here. So we can either use a 3 or a 4-tier system. So we're going to start with sectors. Here's all the sectors: basic materials, consumer discretionary, utilities, all those types of things. So the basic sectors in the economy. From there we can go to industry groups. So within each sector there are industry groups. Within each industry group there are industries, and then finally sub-industries. So we can go however far we need to. We could look at basic materials as an entity. We could break that down into the industry groups, and we could break those down into the industries themselves and then sub-industries underneath that. So you can go 3 or 4 tiers down in a commercial classification system is the way this normally works. We also have a government classification system, North American Industry Classification. And that's going to give it, the first 2 digits are going to tell us the sector. The 3rd digit is going to tell us the subsector. The 4th digit is going to tell us the industry group. The 5th digit is going to tell us the industry. And the 6th digit is going to tell us the country. So these don't get updated particularly often. Of course, they are generated by the government, which my initial biases, that makes it less useful. But nonetheless, this is another way that we could classify industries. And the reason it might be important is not that we think the classification is so great, but we may have access to data through these particular grouping channels. So when you're out there trying to find data that you can use for your valuation, you may need to use this from time to time. So one of the problems is it doesn't distinguish between public, private, large and small, profit, nonprofit, all that sort of thing. So they're all lumped in there together under however many digits you want to use when you're in your search. More on this business cycle sensitivity. So a cyclical business, this is one that's going to have whose returns are going to be highly dependent on the business cycle. So, the business cycle, you talked about this in macroeconomics. So you can think of, GDP growth. So I'm going to use a capital Y. That's the, macro symbol for GDP or output. And, it's going to look like this, right? So you're going to have this up and down. That's one of the earmarks of a capitalistic economy. If you have a really cyclical business, well, it's going to go up and down with the economy. And if you have a really, really cyclical business, it's going to do it in exaggerated fashion. So it's going to go way up when the economy's up, and it's going to go way down when the economy's down, and way up again as the economy recovers. So something like Apple, when times are good, everybody needs a $1,000 iPad. But when times are bad, then suddenly, getting that whatever it is, Toshiba tablet at Costco seems a whole lot more reasonable investment. Okay, for a non-cyclical company, this is one that, still we have the business cycle, right? So this is time against our GDP measures. This is still happening. But if it's non-cyclical, okay, it's going to have much lower variation. It may not have zero variation, but it's going to have a muted response. And that can be because it's a defensive industry, and I don't mean a defense industry. We're not making bullets and bombs. But defensive just means that as times get good, you don't sell a whole lot more, and when times are bad, you don't sell a whole lot less. So it's, basic goods, consumer staples, things that you have to have relatively stable demand through time. The other reason for that could be that this is just a growth firm, right? So when there's been, I guess we went through this, the financial crisis, and I was trying to think of an industry that was growing rapidly during that. But the recession before that, biotech just continued to roar right through it. So if you're working for a biotech firm, you didn't even know there was a recession. So that was just a growth in demand. Interest is so strong that the business cycle just really doesn't slow you down. And so you're non-cyclical. You don't respond to changes in the business environment, but it comes from different places because demand's so stable, or demand is, interest and the growth in demand is so strong that you're not impacted by the business cycle. Okay, peer groups. So we can think about peer groups for our analysis, and what we want to do is start with a narrow commercial classification typically. So we want to find specific competitors and get their annual reports. And from there, we're going to be able to look at comparable companies. So when we get these comparable companies, we can also use industry reports, or we may actually be writing industry reports in some cases, management comments, those types of things. And then from that set, so start with specific companies, get to those that we actually want to use, okay, we're going to come up with a group of companies that have a similar business model, similar activity, hopefully similar drivers of demand and cost structure and those types of things. And that's going to be a group that we can use as saying this is a reference if we want to do relative valuation, or if we just want to understand how this firm creates value. So the determination of peer groups, this is an art if there ever was one, the ability to choose good peer groups and understand what drives value, what drives cost, what drives demand, those types of things is the real skill, in my opinion, involved in analysis. And so if you're good at that, then you're going to be happy with your choice to come into this industry. Okay, what about elements of industry analysis? Okay, so these are things that we would look at if we were doing industry analysis. We want to understand, of course, the relationship between the macro variables, right, and the industry. So the macro, we're either on upswing, or we're at a peak, or we're falling, or we're at a trough, or we're back on the upswing. What does that say? About the industry? Well, if you're looking at Procter & Gamble, maybe doesn't have much impact. If you're looking at a furrier, someone who sells mink coats, then it's going to have a huge impact, right? So we want to estimate industry projections using different approaches and scenarios. So, all right, we understand the industry, we understand how the macroeconomic cycle is going to impact it, and then we're going to say, well, okay, how is this going to evolve through time? And we're going to come up with some way to project what's going on with the industry. We're going to cross-check against other analysts' reports, so they're out there on the internet, you can find them, and we also want to compare our industry valuations across time to determine, risk and the risk of our analysis. How well do we understand this? What has worked in the last cycle? Those types of things, and maybe also to inform rotation strategies if you're a portfolio manager. We want to analyze industry prospects using strategic groups. And these strategic groups mean that it's even a more narrow group. We're going to put this together so that it is, again, these firms that have similar drivers of demand, similar cost drivers, similar access to capital, so that we can say, well, we're going to look at the industry prospects, but we're going to do it within a more focused sample to some extent, right? Then we're going to classify the industry within the life cycle. We're going to talk about that, but here's, the life cycle is typically, I'll just tell you, we're going to see this coming up, so I'll wait to talk about it then, but CFAI has never met a life cycle they didn't like, so thinking about how that's going to impact products and industries is going to be important. Okay, we want to think about where the industry is on the experience curve. So this has to do with learning, and you can think of this as if you looked at cost per unit against number of units produced over all time, right? Well, when you produce your first unit, your cost is going to be real high. You've done something before, whatever it was. The first time you did it, you screwed it up, right? Okay, but the second time you did it, so this is going from 1 to 2, well, you did it better. You didn't make those same mistakes. Well, what you've done when you go from 1 to 2 is you double your experience, right? Well, most of these experience models are based on the doubling of experience. So we're going to look at how much we can learn between 1 and 2, and then we're going to probably apply that same increment to going from 2 to 4, right? So 2 to 4 would be out here, and then as we go from 4 to 8, we'd be out here. And 8 to 16, way over here, we'd be down here. So where are we in terms of this learning curve? So we're always going to be learning. We're always going to be getting cheaper. But once we've produced 100 million units, well, it's going to take a long time to get that next increment of learning, right? So, but understanding what's happening. If we're up here, we have low industry experience, well, it's been rare that you would find an industry that, produces 4 units and then cost is level after that. Right? So this idea of what happens to industry cost / productivity as you learn more, okay, well, that is something that makes for a really interesting portion of the industry analysis and a really important part of equity analysis, especially for those that leave it out because they miss something big. Okay, we want to consider demographic, macroeconomic, government, societal, technological influences. We're going to get to talk about these later, so I'm going to leave that for then. And then we want to examine the forces that determine industry competition. All right, and that in particular relates to this slide, Porter's 5 forces. So this is Michael Porter's work. Michael Porter asked a relatively straightforward question. He says, what does it take for a firm to outperform in the long run? Okay, to have superior performance in the long run. And the answer came in 2 parts. One of them we'll see at the end of this reading. That was they've got to have a competitive advantage. So we'll see that right at the end. And the second part was they have to be in an attractive industry, right? So if we want to talk about the industry attractiveness or how competitive the industry is, this is Porter's 5 forces, and I think you should be sort of mumbling these in your sleep as you approach exam day. So this is a really common analysis. If you've been to business school, you've seen it, certainly if you got an MBA. So if you want to think about in the industry or the attractiveness in industry, you want to use these 5 forces. So rivalry, threat of new entrants, threat of substitutes, then bargaining power of buyers and suppliers. So let's think about this as 2 and 3. So the threat of new entrants means that there's new firms coming in that could compete against you. Well, there are industries where it's really easy to compete. So if you want to raise wheat, well, all you need to raise wheat is 40 acres and a mule, right? So you can become a wheat farmer, so very low barriers to entry there. However, if you want to become a new microchip manufacturer, well, the capital requirements there, the technology requirements are really high. So the threat of new entrants there is going to be much lower. Okay, but you don't have to have new entrants into the same industry. Okay, you could also just have substitute products, okay, from another industry. So what is the likelihood that there's going to be a viable substitute product? Okay, what is the propensity of people to switch? What is the cost of switching? So for instance, if you think of gasoline, I personally drive a hybrid car. And I love reading about solar energy and all those types of things. But at the moment, there is no good substitute for gasoline. And it just really doesn't matter what you say. You're not going to convince me otherwise, right? And I've done the research. So anyway, so there's just no good substitute for gasoline. So so in that case, the viability of substitute products, I'm hoping that's going to change eventually. But right now, there are no good substitutes. Also, because it is so expensive to get into that industry, the threat of new entrants is fairly low. So if you think of oil and gas refiners, on these 2 dimensions, I think they are not safe, but relatively safe maybe, all right? We can look down here, bargaining power of buyers and suppliers. So here's you, right? Here's your suppliers. And here's your customers. So what we're doing is we're looking up and down the supply chain, right? So the question is, who's going to usurp the value here? Well, if you're thinking in terms of the jet airliner industry, well, there's, 20 or 25 entities worldwide that control 75% of the seat miles. So, the big American airlines, the big national airlines, those types of things. So I'm thinking that the concentration of customers, the combination of the concentration of customers and the importance of the product that Boeing or Airbus is selling in terms of profit and loss, it's a big part of their balance sheet and P&L statement, that the customers are going to be really cost conscious. So I think that the bargaining power of buyers, given that there are few of them, they're concentrated, I think it's going to be high, right? On the other hand, if you think about the diamond industry, where the customers are just sort of googly-eyed kids buying engagement rings, and the supplier is the best example of a worldwide cartel, that is the De Beers cartel, well, I'm betting that the De Beers cartel is going to usurp the value. So if you're selling diamonds, okay, then I think the suppliers are going to usurp the value. You, as maybe your Zales, you're going to earn a normal return. You can be a little better or a little worse depending on how efficient you are. And the customers are just going to, or the kids, right? Anyway, so, or if you're talking about the customers as the major airlines and you happen to be Boeing, well, the suppliers, they actually could have some power in that industry too, but let's call it sheet metal or whatever goes on the outside of the planes. Then I think the customers are going to be strong there. So who's strong? Is it you? Or is it someone above you or someone below you? That's the bargaining power of buyers and suppliers. So here we're looking at essentially competition, either from within, more competition in the industry, or substitute products. Down here we're looking at the supply chain. And then up here there's this other sort of catch-all, and that's rivalry among the existing competitors. And in some cases there are industries where the rivalry is just takes on less in-your-face characteristics, right? So maybe that's something like golf clubs. I don't play golf, so I don't know anything about it. But anyway, so golf clubs, maybe there's different price points, and there's some competition, of course, but no one's trying to drive anyone else out of business. One of the grand champions of high rivalry industries is the airline industry, right? So if Delta's flying, Delta flies from LA to New York, well, if they cut their fare for $60, then what does everybody else do within 24 hours? Well, they're probably going to respond to that. So those people, the airline industry has lots of rivalry, lots of price competition, and they're willing to compete the value add away. So the returns are going to be fairly low, right? Anyway, in fact, the total returns to all equity holders over the entire existence of the U.S. airline industry has been zero. Anyway, so some really high returns, but also lots of Braniffs and Easterns and those types of things. Okay, so barriers to entry. So high barriers to entry are going to limit new competitors. So, you got an idea for a business. Well, if you can start a business and build a wall around it, then you may earn superior profits for a while. But if you can't build a wall around it, then the economic model says that somebody's going to come in and compete with you. So to determine the ease of entry, you can look at the industry composition over time. And if the same 4 or 5 firms have controlled 50 or 60% of the market share over time, well, that's because no one else is able to come in and compete with them. The barriers to entry are high in some form or another. So now the barriers to entry, just because they're high, may not imply pricing power if the competition among the existing firms is strong. So if they're selling undifferentiated products or there's high barriers to exit, right? So there's barriers to entry, there's also barriers to exit. So you've got lots of really specialized assets. It's hard to redeploy those in another direction. Then even though there's no new competition, the fact that everybody's product looks the same and the barriers to exit are high, well, there may not be any pricing power there. So barriers to entry and competitive environment, of course, can change over time. So, no gig lasts forever. I had a good friend tell me that. Anyway, and I've come to believe it. So industry concentration. So the industry concentration, it talks about, of course, how concentrated the industry is. So you can think of it as, airlines where you have, 20 competitors that control a big portion of the market share. Versus wheat farmers where, the really big players have, 1/100th of 1%. Maybe that's too low. I don't know. Anyway, but there's certainly a lot of wheat farmers and really low concentration. So low concentration means high competitiveness, right? Overall, what we want is lots of competitors in there. But there's sort of this unusual aspect in that the absolute market share may not be as important as relative market share. So having 40% market share, if you have other competitors out there that are 30 and 30, well, you're only a little bit bigger than your competitors, but you may have 5% market share when your next largest competitor is at 0.5%. Well, it's that relative market share that actually ends up implying that you have greater pricing power. So low industry concentration, that's a fragmented industry. That means high competition. And in a low concentration industry, there's very little pricing power. All right, so you can have it or not have it depending on the structure of the industry and that type of thing in a concentrated industry. But if you're in a fragmented or competitive industry, there's very little pricing power. Okay, so industry capacity. So what is the capacity supply, the ability to supply relative to demand? Well, if you have undercapacity, that is demand exceeds supply, then there's very frequently pricing power, right? You got people standing in line for your product. They want more product than you can produce. So undercapacity does imply very frequently pricing power. Overcapacity can lead to really strong, really intense price competition, especially if no one can exit the industry, right? So we saw this, and well, you see this in like the microchip industry from time to time. So they have excess supply. Well, you've got all these specialized assets. You can't do anything else with them. Well, it leads to really high levels of price competition. So capacity, of course, is going to be fixed in the short run. We can only run our machines 24 hours a day or 23 hours a day if you want to allow for servicing. So capacity is fixed in the short run. So we can either have capacity that is higher or lower than demand. But in the long run, capacity is variable. So in the long run, supply is going to meet demand. Okay, what we're talking about with under and over capacity is a short-run phenomenon. So the other thing to note is that we can have a major overshooting of capacity. So if we have an undercapacity situation and then everybody says, whoa, we're making so much money and we have big margins because we can charge high prices, let's build another plant. So everybody builds another plant. Well, if these are really specialized assets, a lot of fixed cost here, well, once we get into this, it's going to lead to a massive jump in capacity, and that may also be combined with the fact that the market was at a peak and now it's going to be coming down. Well, we can end up overshooting the capacity needs in the industry. So if if we look at non-physical assets, that is financial capital, human capital, those types of things, or skills, we can redirect that really quickly compared to physical capital. So if you have a lathe, right, well, there's a number of things you can do with a lathe, but all of them have to be associated with something that you want to make round, right, because that's what a lathe does. It spins stuff around and you make it round. So if you don't have, your ability to say, well, we have this lathe, can we redirect that into the ice cream business? Well, probably not is the answer, right? So physical capital comes into production more slowly. That allows for the overshooting. And if the physical capital, if capacity is physical and specialized, okay, well, that's where we're going to get the biggest problem with our overshooting, right? Market share stability, we've talked about this a little bit already, but if we have highly variable market shares, that suggests a very competitive industry. So anyone who gets a little bit of an edge, okay, is going to, going to gain market share for a while, and then they're going to give it up to somebody else who has the next innovation. So if you have lots of variability in market share, somebody has 20% this year, but then they only have 2% next year, and it keeps who the leading four firms are, 3 of the 4 are always knocked out from year to year. Well, that means that's a firm that's going to have an industry with very little pricing power. It's a very competitive industry. So stable market share, on the other hand, suggests less intense competition. Why? Because we've had the same 4 firms sitting there fat and happy. So high switching costs, if you have an industry where you've got this low intensity competition, well, why do you have that? Well, it might be that the switching costs from those products are really high, either to switch from one supplier to another within the industry or to switch to a substitute product outside. If the switching costs are high, then you're kind of locked into to doing that same thing with the same supplier through time, until you finally get so fed up with it that you're willing to incur these high switching costs. Okay, industry life cycle. So we talked about or referenced life cycles a little while ago, but the notion here is we want to think in terms of industry. You can also apply this to product life cycles, like I mentioned earlier, I don't think CFAI has ever met a life cycle they didn't like, right? So you want to make sure and be able to think through these different stages. So an embryonic stage, This is, this is also referred to sometimes as the pioneering stage. This is where you have, really high cash burn rates. You need lots of capital. You got the highest risk of failure because you have a product that does not yet have a market. Okay? It doesn't have a consumer acceptance. So growth is slow. Prices, they may be making something really neat, but it's, prices are so high, nobody buys one. But and a lot of those businesses fail, but the ones that don't fail move into the growth stage. And the growth stage is where now the people are saying, hey, I think that is worth whatever they're charging. So people start buying it. That leads to rapid demand growth, and we still have low competition since we sort of, started this out in the middle of a field somewhere where there wasn't any competition. So what we're going to see at the same time is falling prices and higher profitability. So prices per unit are going to be falling, but we're going to have such massive economies of scale that, and increasing sales, that profits are going to be going up in this growth stage. So this is a really fun time to be involved in a business. The shakeout stage, which is also is called the stabilization stage in other places in the curriculum. Well, this is where growth starts to slow. So the competition starts to intensify, and you can see the emergence of overcapacity in at least some segments of the industry. And what you're going to see is also declining profitability, possibly, but what you'll also notice is a lot of cost cutting. So if you worked at a business where, it was small and you guys were, all unified, and it seemed like every day was a party because things were going so well. Every Friday they bought lunch for you. Well, and then suddenly you get a memo saying, we're not doing lunch, but we're going to have a company picnic once a year. Well, that's the cost cutting that happens as you move out of the growth stage and into the shakeout stage, right? So we'll also see some failures here in the start of maybe some merger acquisition type activity. That's going to lead us to the mature stage. This is where we're going to grow at something approximating the the economy average. So if you want to have an increase, you want to grow at an above average rate, that's what I was trying to say, then you're going to have market share increases. So you're going to have something that's going to make you better, superior products, or be a cost leader or something like that. If you have relatively stable demand, then the industry may not start eating itself. Okay, so we may be able to avoid price competition for a while. But once we hit an economic downturn and overcapacity becomes a big issue, then what we usually see is price cutting is going to take a spike here in the mature stage. And then finally, the decline stage. This is where you have negative growth. You're going to have the weak firms are going to exit or fail. And it's going to be associated with this really a desperate attempt to cut costs and those types of activities. So you can see decline stage stuff. And why do they decline? Some reasons here. Technology. Example of that would be newspapers. So newspapers are really struggling to survive. Who reads a newspaper anymore, right? So global competition. So you think of the U.S. textile industry has really struggled for the last 30 years. Social change. So declining beer sales in Germany. I actually didn't know beer sales were declining in Germany until I read this. But nonetheless, I guess Germans are getting tired of beer after 400 years or whatever it's been, right? So the industry life cycle, you want to be able to think through, read a little bit about a company and determine where in this 5-stage life cycle they are. And if you want to think about it, you can, in terms of your life, you can think of it this way. If you have a friend who is starting a business and he just seems to be depressed, he's working 18 hours a day, 7 days a week, and doesn't seem to be getting anywhere, he's in an embryonic stage. Okay? And then you see that he buys a big house. Okay, suddenly he's really popular at parties. Well, his firm's entered the growth stage. Okay, and then about the time he's buying his first Ferrari, that's the shakeout. There's going to be some cost cutting, and everybody's going to be talking bad about him because they're not buying us lunch anymore, but he's just bought a Ferrari. So that's going to be the shakeout stage. Okay, the company you work for, that's a mature stage, and the company your parents worked for, that's a decline stage company, or industry. So you can think about it that way if you want to apply it to your life. Let's see, the limitations of life cycle analysis. Of course, it's more useful during stable periods, but it's during volatile periods that we really need it, the insights from it. So yeah, it's more useful during stable periods, sort of like, I guess crystal chandeliers are more useful when there's not an earthquake going on, right? So, but anyway, that is true. It is more, it's easier to do when there's stable periods. So stages are not as long as they anticipate, so you can move through these stages really quickly, or it can even look like they get skipped altogether. You can go from, this sort of shakeout directly into decline if they're a really short-lived industry life cycle. And of course, some firms are going to have experience that is different than what we've described here, even if the overall industry would behave like we have described in the life cycle. Okay, now let's think about elements of strategic industry analysis. So I think we've seen a lot of this before, so you can think of this kind of as tabs in an industry analysis report. Back in the old days when we did it in paper, put it in a really cool 3-ring binder. We thought that was great. We'd have different tabs. Well, these would be some of the tabs that we would have. We'd want to know who the major firms in the industry were. We want to know the barriers to entry, or the drivers of success. What do these really successful firms do? We want to say something about concentration. So is this really competitive? Is it lower intensity? Those types of things. We want to think about the influence of industry capacity and pricing. We want to know something about stability. So has this industry had slow, steady growth? Has it been growth that has been constantly high, right? So we see big changes, but they're always positive. Where are we in the life cycle? And then something about competition, both from within and outside the industry. Demographic influences. If you live in the first world, then if you think demographics, the first thing your mind jumps to is the graying of society. We're getting older. By the way, that is a first world bias. The world population overall is getting older, but today the world population is young by historical standards. So this idea that there's not going to be anyone to serve the lemonade because we're all going to be so old, well, that's a first world bias. Government influence. So is this something where we're going to expect increasing government oversight? Those types of things. Social influences. This is like the trend to dual income families. So I remember the origin of DINKs. So D-I-N-K. So dual income, no kids. Well, I remember telling my wife we're sinks, single income, numerous kids. So anyway, so that would be a social change. Technology and technological influences. And then finally, what does the industry classification look like in terms of, is it a growth industry, defensive, cyclical, all that type of stuff. So we would want those elements in our strategic industry analysis. When we want to analyze growth, profitability, and risk, well, this is more of the same here, but of course, if we want to understand growth, profitability, and risk, we've got to understand where we are in the macroeconomic cycle. It's going to impact almost all firms, and in some it's going to have an extraordinary, maybe the primary determinant of growth, profitability, and the risk, in particular the risk of failure. Technology, has the firm adopted new technology? Is it something that you think can be subject to technological innovation? Who is leading that charge? All those types of things. Who's invested in new technology? Who hasn't? Demographics again. So you're going to want to think about, well, if you are in the hospice industry, that's what you've decided to do with your life, well, then the demographics of an aging population may be something that are good for your business because more people are going to be dying slowly. Social influences, again, how we conduct our lives. And finally, the government, and depending on what country you're in, the government can have stronger or less strong influences, or I guess the change in government influence can be greater or smaller. So if we get out of the industry and we go to companies, of course we want to know what does the company do? Where does it come from? Where's their production capacity? Okay, industry characteristics, how does it fit within the industry? What about product demand and product costs? So those are going to be key elements, and I guess product pricing. So in terms of what they actually do, demand, cost, the pricing environment are going to be vital. We're probably going to look at financial ratios to determine their health, their staying power, projected financial statements, and of course a firm valuation going to be something that we are going to be really interested in a company analysis. So to wrap this thing up, elements of company analysis again. Company analysis should examine the firm's competitive strategy. So what is the firm's competitive strategy? I mentioned Michael Porter earlier. I said Michael Porter asked a simple question. He said, what has to be in place for a firm to outperform in the long run? And the big part of that answer was they have to be in an attractive industry, and that was Porter's 5 forces. The other part was they had to have a competitive advantage. Okay? And he identified two sources of competitive advantage. One was you could be a cost leader, and the other is you could be a differentiator. So if you think of this as, here's going to be, average cost, right? So this line is going to represent average cost. Well, if you're a cost leader, and so this is going to be average cost, and this is going to be average price. There we go. So this spread between price and cost is going to lead to a normal return, right? That's going to be just enough to cover the cost of capital. But if you're a cost leader, you're going to have cost down here. So you can sell for the average price, and you're going to have bigger margins because you're the cost leader. And if you're a differentiator, you can have average costs, but you get to differentiate and sell for a higher price. So this might be someone like Converse tennis shoes as a cost leader, and Nike tennis shoes, right? So cost leader versus a differentiator. So, and the idea here is, which do you do? Do you differentiate your product, or are you a cost leader? If you don't do either of these things, you're a stuck in the middle firm, and you're going to get returns that are just compensation for your time and effort and the capital involved in those types of things. All right? So lots of concepts here. Most of it, if you will, thinking is always dangerous, but if you will think through this, I think you'll find that a lot of this makes intuitive sense, and you can also combine this with some stories in your mind that I think will make this material fairly easy to get on top of. So good luck with this.